I've been thinking about something that doesn't make sense to most people right now. Iran just shut down the Strait of Hormuz. Bombs are falling. Oil tankers burning in the Persian Gulf as I write this on March 13th. And gold? It's falling. Not rising, falling. From $5,419 when the first strike landed on March 2nd down to $5,085 today. Silver crashed from $96 to $82. Every investor I know is asking, if this isn't the crisis that sends gold to the moon, what is? But here's what they're missing. The real move hasn't started yet. What's happening right now? This price suppression you're watching in disbelief, this is the setup, not the failure. The setup. I've seen this exact pattern before. Every single time a major geopolitical shock collides with an over-leveraged monetary system. The investors who understand what I'm about to explain will be positioned for the largest precious metals move in modern history. The ones who don't will sell at exactly the wrong moment. Let me tell you what actually happened on March 2nd. At 3 a.m. Eastern Time, Operation Epic Fury began. U.S. and Israeli forces struck Iran. The supreme leader was killed. Within minutes, gold surged to $5,419. Silver hit 96.40. Oil spiked 13% before New York opened. Every financial outlet ran the same headline. Safe haven demand, flight to quality, the gold trade is back. Retail investors did exactly what the media told them to do. They bought. Gold at $5,400, silver at $95, defense stocks at the peak. Then something happened that nobody explained clearly. Gold fell. Hard. Silver dropped 7% in a single session. As of this morning, both metals are trading lower than before the war started. The investors who bought the spike are underwater, and almost nobody is asking the right question. The right question isn't why gold fell. The right question is, what mechanism is powerful enough to suppress gold during a war, and how long can that mechanism last? The mechanism that suppresses gold short-term is always temporary, and when it reverses, the move is violent, concentrated, and larger than the initial spike. So what is that mechanism? The number you need to understand isn't 5,085. It's 0.4. That's how much the 10-year Treasury yield rose on March 2nd, right as gold was spiking. The war that was supposed to be bullish for gold simultaneously triggered the exact condition that suppresses it. Higher oil prices drove inflation expectations higher. Higher inflation made the Fed less likely to cut rates. The 10-year yield rose from a 4-month low. And when Treasury yields rise, the opportunity cost of holding gold, which pays no interest, rises with it. At the exact moment gold spiked on fear, bond yields spiked on inflation, and yields are the most powerful mechanical suppressor of gold prices in the modern financial system. Here's the sequence. Oil up, inflation up, Fed hawkish, yields up, dollar up, gold down. That's the mechanism. It played out perfectly on March 2nd. The war that should have sent gold higher created three conditions that push gold lower: rising yields, rising dollar, forced liquidation. Most investors have never been taught this relationship. When gold falls during a war, they think the thesis is broken. It's not. It's running exactly as the mechanics predict. And here's what matters most. This suppression mechanism has a shelf life. It works only as long as the market believes the Fed can fight inflation by keeping rates high. But look beneath the surface. The United States is rolling over $9.2 trillion in federal debt this fiscal year at 4% to 5%. Annual interest payments just crossed $1 trillion, more than the entire defense budget. The arithmetic of sustaining high rates against $36.2 trillion in debt isn't indefinitely sustainable. The moment the bond market concludes, the Fed will be forced to choose between fighting inflation and servicing the debt. Yields stop rising and start falling. When that happens, the three headwinds on gold reverse simultaneously. Dollar weakens, yields fall, gold responds to both the inflation the oil shock created and the monetary response the debt forced. That's not a 10% move. That's the 1979 scenario. Let me show you why this reversal is coming. Go back to 1973. OPEC embargo hits. Oil goes from $3 to $12. Gold spikes, pulls back, trades sideways for months. Retail concludes gold failed. They sell. Then the real move begins. Not when fear was highest, but when fear gave way to the realization that inflation was structural, embedded in the system, impossible for central banks to fight without destroying the economy. From 1971 to 1980, gold rose 2,300%. Not from the spike. From the moment the structural case became undeniable. 1979, Iranian Revolution, oil surges 110%, gold climbs 150% in 2 years. The pattern: geopolitical shock, initial spike, mechanical suppression, structural reversal. What makes 2026 different? 3 things. Layer 1. The oil shock isn't temporary. Iran's Revolutionary Guard shut down the Strait of Hormuz. That's 20% of global oil consumption. No concrete plan to reopen it. Wood Mackenzie warns of $100 oil. Goldman Sachs priced in an $18 per barrel risk premium. Every week the strait stays closed is another week of energy costs feeding into core inflation, keeping yields high, keeping the suppression running. Layer 2, the debt dynamics are unprecedented. In 1973, U.S. debt was $500 billion. Today, it's $39 trillion. That's not a larger version of the same problem. That's a fundamentally different fiscal reality. The Fed can't raise rates to 20% like Volcker in 1979 because the interest cost would be $7.8 trillion annually, more than total federal revenue. The Fed is trapped between inflation and insolvency. Layer 3, central bank behavior. In 1973, central banks were selling gold. Today, they're buying at record levels. 863 tons purchased in 2025. 3 consecutive years above 1,000 tons. This isn't diversification. This is strategic repositioning at a scale the market has never seen. Continuing despite gold already above $5,000. JP Morgan just raised their year-end target to $6,300. Deutsche Bank holds at $6,000. These are research departments of institutions managing more capital than most countries' GDP. Now let me tell you about silver. Silver crashed from $96 to $82. That's 14% during a war. Why? Silver is half monetary metal, half industrial. War fears boost investment demand, but recession fears hurt industrial demand. That dual nature makes silver more volatile than gold. But the structural case hasn't changed. 6 consecutive years of supply deficit. COMEX inventory down 64% from 2020. China restricting exports as strategic resource. Industrial demand from solar, EVs, AI, defense, all rising. The price fell. The thesis didn't. Historically, when silver retests support in a structural bull market and holds, the next leg up is bigger than gold's. In 1979, gold rose 276%. Silver rose 900%, from $5 to $50, 10 times. When the monetary bid returns, the industrial demand that ran continuously adds to it instead of subtracting. That produces silver's characteristic pattern of lagging gold, then overtaking it dramatically. Let me be direct about where we are. Based on price action, timeline, forced selling from leverage, we're transitioning between Phase 1 and Phase 2. Phase 1 is panic spike. Retail buys at the top, get stopped out. Phase 2 is structural bid. Panic exhausts. Forced selling completes. Central banks keep buying. Institutional allocators start accumulating. Structural buyers who don't care about short-term volatility begin building positions at prices that will look obvious in hindsight, but feel uncomfortable now. That's where we are. $5,085 gold, $82 silver, both lower than before the war. Both setting up for the move that makes March 2nd look like a warm-up. I've watched 2 types of investors in every crisis. First type sees gold at $5,085, down from $5,419, concludes the trade is over, bought the spike, sold the dip, locked in losses. 6 months from now, when gold makes new all-time highs, they'll say, I knew I should have held. Second type sees the same price and thinks, Phase 2, mechanical suppression, structural case stronger. They accumulate quietly while the noise is loudest. Here's what I'm watching for reversal. 2 indicators. First, the dollar index, currently elevated above 99 from emergency petrodollar demand. When DXY falls below 97, The primary mechanical headwind diminishes. That happens when oil stabilizes, when alternative routes absorb enough Hormuz disruption. Second, the 10-year Treasury yield, currently at 4.14%. When this falls below 3.5%, the opportunity cost argument weakens to where institutional rotation becomes mechanically favorable. That happens when the Fed starts cutting, which happens when debt arithmetic makes it impossible not to. Watch those two numbers. Everything else is noise. The dollar and yield will tell you. When both turn, the suppression exhausts, and gold responds to the structural reality building underneath. The question every investor needs to ask isn't whether gold should have gone higher during the war. The question is whether the structural conditions that drove the 1973 to 1980 move are present today. U.S. debt in 1973, $500 billion. Today, $39 trillion. Central bank gold buying in 1973, zero. Today, 863 tons annually. Silver supply deficit in 1973, none. Today, 6 consecutive years. Fed's ability to raise rates in 1973, unlimited. Today, constrained by $1 trillion in annual interest payments. Oil shock in 1973, temporary. Today, ongoing, with no resolution. Every structural condition is more extreme. Every driver is more powerful. The suppression mechanism is temporary. The structural case is permanent. JP Morgan's $6,300 target. Deutsche Bank's $6,000 target. 863 tons of central bank buying. These are calculated outcomes of institutions doing the same analysis I'm laying out. The move coming isn't unthinkable because it's never happened. It's unthinkable because the conditions driving it are more extreme than anything in the historical record. The window is open now. $5,085 gold, $82 silver. March 13, 2026. Tankers burning in Hormuz. Fed meeting in 5 days with zero rate cut probability. $9.2 trillion in Treasury debt rolling over. Most investors watching the short-term price fall, concluding the crisis is over, completely missing the setup forming. The 1973 investors who held through the pullback turned $10,000 into $243,000. The question isn't whether gold went up enough. The question is whether you understand the difference between the short-term price and the structural price. Most investors don't. Now you do.